In this video lecture, we're going to look further into the debit and credit rules and look at how to record revenue, expense, and dividend transactions. We'll also be talking about the concept of double entry accounting. So in the last video, we looked at asset, liability, and equity accounts and the ways in which they are increased and decreased by credits. Recall that our equity accounts, common stock and retained earnings, are both increased by credits, decreased by debits, and have normal credit balances. Going back to transaction analysis, we discussed how revenue and expense accounts are subsections of equity. Because revenues increase retained earnings, the accounts function the same way. The revenue account is going to be increased with a credit, like retained earnings, and decreased with a debit, and have a normal credit balance. We know that expenses decrease retained earnings, so expense accounts are the opposite of the way the retained earnings account functions in terms of debits and credits. So the expense account is going to be increased with a debit, the opposite of revenues and retained earnings. It's going to be decreased with a credit and have a normal debit balance. Here's a tip. During an accounting period, you're generally only going to credit revenue accounts and debit expense accounts, because what we're trying to do with these accounts is accumulate activity during an accounting period. So if you're only crediting your revenue account every time you satisfy a performance obligation, the balance in the revenue account is going to reflect the total amount of revenue that you earned during that period. We're going to have separate accounts for each of our expenses, but for each of those accounts, let's say we're talking about the salary expense account, every time we pay our employees, we would debit the salary expense account, and at any given point, the balance in the salary expense account shows us what we have spent or incurred in the way of salary expense for the period. The dividends account is going to work like the expense account. So here's a summary. We have assets, liabilities, and equity, which is our basic accounting equation. Assets are increased by debits, decreased by credits. Liabilities and equity are on the opposite side of the accounting equation, and they work the opposite way. They're increased by credits, decreased by debits, and have normal credit balances. Revenues increase equity, specifically retained earnings. So the revenue account works like the other equity accounts. It's increased by credits, decreased by debits, and has a normal credit balance. The expense accounts and the dividends account both decrease equity, specifically they decrease retained earnings, so they work the opposite way of your other equity accounts. They're increased by debits, decreased by credits, and have normal debit balances. Typically during an accounting period, you will only credit revenue accounts, you will only debit expense and dividend accounts. So just a tip for remembering this. Recall that each account has a normal balance, which is its increased side. For assets, expenses, and dividends, that's a debit. For liabilities, stockholders' equity, and revenues, that's a credit. So in the short run, you can use this acronym DED curls to help identify the increase and normal balance side of each of your account types. The D in DED stands for debit. EAD is expenses, assets, and dividends. The capital C there stands for credit, and the RLS is revenues, liabilities, and stockholders' equity. All right, so DED curls. We're going to go through some transactions now and look at how they're recorded in our T accounts. So recall that a T account is just a device for summarizing the activity with regard to a specific financial statement item. There are three components to the account. It's got the title, it's got the debit side, it's got the credit side. Debit means left side of the account, credit means right side of the account. So for our first transaction here, we have $100 cash received in exchange for common stock. We are going to debit or increase our cash account, and we're going to credit or increase our common stock account. Cash is an asset, it's increased with a debit. Common stock is an equity account, and it's increased with a credit. So one of the things you want to note here is that in each transaction, the debits have to equal the credits. So this is what is referred to as the double entry accounting system. Each transaction is going to impact at least two accounts. There's going to be at least one debit and at least one credit, and the debits have to equal the credits. For the first entries we do, they're known as simple entries. They're going to have one debit and one credit each. Eventually, we'll move on to compound entries where you may have more than one debit and or more than one credit. Our second transaction, we have a purchase of inventory on account. We know that when something is purchased on account, it basically means that they charged it. And so we owe that amount, and it is referred to as accounts payable. It's a liability. So we're buying inventory. We want to increase our inventory account with a debit of 120. Assets are increased with debits. Accounts payable is a liability. It's increased with a credit. So we are going to credit accounts payable. So referring back to the double entry accounting system, two accounts, inventory and accounts payable, one debit and one credit, and the debits equal the credits. They're both $120. Transaction number 3, we perform services valued at $140 on account. All right, so we've got this on account verbiage going on again, but in this case, we're not buying something, we're selling something, we're performing services. So in this case, we perform services and sent the customer a bill. The amount that they owe us is referred to as an accounts receivable. So you can think about that as an account to be received, accounts receivable, an asset, as opposed to an account to be paid, accounts payable, which is a liability. So we're performing services and the amount is owed to us. We want our accounts receivable account to show that we are owed $140, and we want our service revenue account to show we have earned $140. So asset accounts are increased with debits, revenue accounts are increased with credits. So we have a $140 debit to accounts receivable and $140 credit to service revenue. Transaction number 4, we're going to pay weekly salaries of $200. So salary expense, an expense account, is going to be increased with a debit. What we want to do with our expense accounts is show the expenses we have incurred during the period. So every time we incur an expense, we're going to debit the expense account. We're paying out cash. Whenever we pay out cash, we want to decrease the cash account with a credit. So hopefully these basic entries have given you an idea of how you use debits and credits. My advice at this point is to go practice these transactions.